Just 6 months ago, it looked like Mapletree Industrial Trust would be climbing back to all-time high. It crossed $2.50 and was going on an uptrend. But what happened? Interest rates started to come up, correct? And that impacted all REITs. And that's in the red line depicted over there. Interest rate going up is simply a headwind for all REITs. Very recently, there was further bad news for data centers. The emergence of DeepSeek threw a question as to whether there's so much need for data centers or not. That is in the orange downturn over there. And just in case it wasn't bad enough, a last final nail in the coffin, which is a negative report from a JP Morgan analyst stating that Mapletree Industrial Trust future dividends could be trending down. All in all, this triple whammy has made Mapletree Industrial Trust the worst performing REIT in Singapore for the last 1 month at minus 8.1%. Wow, how in the world did a blue chip REIT, which is one of my biggest holdings, end up as the worst performer? At least to me, it was beyond all imagination. That is why I had to do investigation work. And today in this episode, I'll be sharing it with you. Hi guys, welcome back. Let's start with what this JP Morgan analyst has specifically mentioned. He has mentioned that there is a possibility of a decrease of approximately 4% in DPU over the next 2 years. The reason is because there are tenants that are leaving some of its major properties in US. Not just that, he has highlighted the risk of aging and smaller scale data centers in US facing obsolescence, which definitely sounds very scary. So for today, I'll break down this discussion into 3 parts. The first is what exactly is this negative report and is it really that serious? The second, I'll highlight all other risks of Mapletree Industrial Trust that I could uncover so that if you were to invest, you go in with your eyes wide open. And last but not least, I'll be ending with my own conclusions. So stay tuned right to the very end. So without further ado, let's look at what exactly is this problem that Mapletree Industrial Trust is facing. The first property is this one in Philadelphia, 2000 Quebec Road. This is a 2-story data center with tenant Vanguard, and they accounted for 1.2% of gross revenue. This lease has actually expired in December already. And it is true, moving forward, this 1.2% of gross revenue will be lost. Management is exploring all options, including releasing the data center or converting it to a different usage or even divesting it, which is to sell it. 1.2% is quite big, and this one, the lease is already lost. Let's move on to the second one, which is 400 Holger Way, San Jose. This is a 2-story data center, which accounts for 0.9% of gross revenue. Its tenant, Center Square, is not expected to renew the lease in August 2025. Take note again, it's August, 6 months later, which means hopefully the management can wake up and go and do something about it, which I'm sure they will be, correct? Management has even initiated a power study on how to redevelop that site over there. Or they could even divest away this data center at a higher valuation. Let's move on to the third one, which is 250 William Street in Atlanta. This contributes 1% of gross revenue. It is a 9-story mixed-use office and data center. The data center is currently fully occupied, and Mapletree Industrial Trust could convert the office space into additional data center space. And it's in discussion right now with Georgia Power on increasing the power capacity for that conversion. From my first impression, as long as the data center component is fully occupied, converting it makes more sense. That suggests that there's demand for data center over there in Atlanta. I would guess that management might need to spend some money for that conversion, but if they do, this could be a way to improve this property. The lease expiry is only in February 2026, which is in 1 year time. No impact in the immediate 1 year ahead. Next, let's move on to the fourth property, which is 7337 San Diego. This is a 5-story building comprising again of data center and office. This is leased by AT&T, and they've extended the lease twice already, and it will expire in May 2026. So again, the problem will only surface 5 quarters later. And if the management is not doing anything, I will be tremendously disappointed. This is a big pie, 2.5% of gross revenue. Management could explore converting it to a lab for life sciences, or it could consider divesting this data center. So all in all, there are 4 properties that could see tenants leaving, one of which the tenant has left already. 3 more, very likely the tenant will leave, of which the last one is more or less confirmed already from everything I read. AT&T has found a new place and they just needed more time to move everything there, so they definitely will leave. But long story short, I think the gut feeling is there is risk of tenant leaving. If the management does not do anything, there will be revenue loss. Because of this, JP Morgan analyst has cut the target price from $2.50 to $1.90. Wow, why is there a need for a 20+% cut when everything we saw was 1% loss, 1% loss, 1% loss, and it's not even immediately? There is time, correct, to salvage the situation. And if we look at the target price across all other analysts, just in January, CGIS has a $2.82 target price for Mapletree Industrial Trust, DBS at $2.75, Maybank at $2.60, OCBC at $2.71, and last but not least, UOB Kay Hian at $2.70. Target prices are target prices. Take with a pinch of salt. Usually, the more important part is whether they cut target prices or not. And with that, I'd like to highlight especially on UOB Kay Hian's one, which was a cut from $2.89 to $2.70. That report was released on 12th of February, which is after the JP Morgan one. And it also highlighted these 4 properties being a reason why they've cut target prices. If I connect the dots, I think analysts were given a briefing from management, or management gave them some answers as to the future of some of the US data center leases. And with that new information, JP Morgan and UOB Kay Hian has quickly reflected a lower target price already. So in that sense, the risk is real. It's just whether it is that serious as what JP Morgan analyst has put it out to be. Again, that's a 20% cut, not a 5% cut in target price. So if they're highlighted, you judge for yourself whether this is a buying opportunity or a real crisis. I have more research to share with you, and as always, smash a like, smash a subscribe button as we march towards 70,000 subscribers. And when there are more news on Reits, such as what we're covering today, I'll give you updates for free in this very channel. Thank you so much, and with that, let's move on to the second chapter, which is what I'd like to highlight to you as additional risks I have discovered as a fellow investor. After the last quarterly earnings, management has stated that borrowing costs would likely inch up in the year ahead. Quarter on quarter, it actually dropped from 3.2 to 3.1%, which is super good news. But they've kind of reduced expectation by telling us that moving forward, it is projected to rise back up to 3.3%. So when it comes, don't panic. The simple reason is because they have some fixed rate hedges that are expiring this year already, and once they start to float, the borrowing cost average rate will start to inch up. Not good news, but also not catastrophic news. It's not like it's going to jump up by 1-2%, just like what we feared back in 2022. Beyond that, there is no additional risk I've uncovered already. Personally for myself, I'm happy as an investor, and that leads to the next section, which is my conclusions. The first thing that we should all take note is that US data centers have reported declining results for a while already. It's not new news, because if we compare 2003 to 2004 US data center performance, you would see that it's been coming down a couple of percent. Last year's profit was $139 million. Most recent, $134 million. So it's a loss of 2-3% already. But this drop has actually stopped if we compare quarter on quarter. That was something I've highlighted in the previous update. This is also one of the reasons why Mapletree Industrial Trust is trying to diversify away from purely US. They are growing their data centers in Asia with their recent acquisitions in Japan. The next thing to note is this entire saga is caused by potential non-renewals of 4 data centers. Is there a chance that they will never be able to find a tenant? Maybe there is, but the more reasonable expectation is that they can find a tenant in 6 to 9 months, which means these properties are not going to become zero. Using one of their recent examples, AT&T, which I mentioned just now, as also a tenant for 7337 San Diego, they moved up from 402 Franklin Road, and what happened is Mapletree Industrial Trust converted this property into a healthcare facility and found a tenant to take it for the next 20 years. The search for this new tenant took 6 to 9 months. But again, it proves that you can find a replacement tenant, it's just a matter of time. Finding tenants is one of the key jobs that a REIT manager should be doing. So I think we need to trust them that they can solve that issue. More importantly, we need to see whether on the ground there is positive reversion up in terms of rent. High-tech buildings in Singapore up 5.4% year on year. Business parks up 14.4% year on year. Flatted factories up 10.1% year on year, and stack-up ramp-up buildings up 8.6% year on year. Even the North American portfolio saw a 2.1% increment year on year. In this analyst report, I've also found something on high-tech buildings, which is our own Singapore National Healthcare Tech, SNAPS. They vacated one of their spaces, and management is also working to backfill this within 6 to 9 months. This reinforces again, they are working on it and usually takes around that time frame to find another major tenant in. Even if they can't find tenants in quickly, there are still some ways to solve it. Mapletree Industrial Trust is still very strong in terms of its balance sheet. They are exploring selling some of their other assets, such as light industrial buildings in Singapore, and they can always sell some of the US data centers. In particular again, the San Jose data center, potential buyers could be plentiful as San Diego is a vibrant biotech life science market. This should give some confidence that at least their property is not gone case. They could even sell it at a good price. Mapletree Industrial Trust has a good track record. They have a strong sponsor, Mapletree, who can give them new pipelines such as some other data centers in Hong Kong for them to further grow their business. Everything I'm hinting to you is to stay optimistic in the market. When I take a quick look at some of US top REITs on data centers, these are two names that come up: Digital Realty and Equinix. What we can see looking at Equinix, who is a pure US data center, it doesn't look distressed at all, correct? Share price has still been trending upwards. Is it really that US data centers are gone case? Probably not, what? It's not across all data center REITs in US that are experiencing a downturn. Equinix has even outperformed S&P 500 over the last 10 years. So all in all, let me know your thoughts in the comment sections. Smash the subscribe if you haven't done so, and check out this previous video I have. Today's video, I touch on the newly surfaced KRIS, but that video, I show you what they did in terms of performance. Check it out too before you invest, and as always, be prudent. With that sound from me, I see you there. Take care as always. Goodbye.